$170. That was the price. $170 per share. In January 2007, no one questioned it. 85 years, not a single year in the red. Founded in 1923. It survived the Great Depression, 2 world wars, the dot-com collapse. Monday morning, March 17, 2008. The price tag on that same share read $2. This is not the story of a bank's collapse. It is a trace of where the money disappeared and where it arrived. This is not an indictment of anyone. The purpose is to show the structure of the pipeline through which wealth moved. Wealth did not vanish here. The moment fear destroyed the price, ownership transferred. The right to set the price moved to whoever held cash. 2006. The air in the American housing market grew thin, quietly. On the surface, everything held. Stock prices climbed. Wall Street bonuses hit record highs. Penthouses in New York sold themselves. Condos in Miami sold out before construction began. Beneath the surface, the numbers were already trembling. Subprime mortgages. Loans handed to borrowers with poor credit. In the fourth quarter of 2006, the default rate on these loans crossed 13%, a number that had been stable, suddenly surging. August 2007, nearly 16%. January 2008, 21%. May 2008, 25%. 1 in 4. 1 in 4 borrowers could no longer pay. But the numbers were hidden. Thousands of home loans bundled into a single security. Millions of mortgages, blended, sliced, repackaged. A derivative built from debt. That security received a AAA rating, the safest grade possible. And it landed on the balance sheets of financial institutions worldwide: New York, London, Frankfurt, Tokyo. The problem? The number existed on the ledger, but no one would actually buy the asset. August 9, 2007, Paris, France. That morning, BNP Paribas announced the suspension of 3 of its subprime-linked funds. The reason? One sentence. Liquidity has completely evaporated in the U.S. asset-backed securities market. Not a loss, a declaration. There is no price. An official admission that there were no buyers. The 3 funds held roughly 2 billion euros, a small number relative to BNP Paribas' total assets, but the shock was not about the size. It was about the declaration itself. When buyers disappear, prices disappear. That afternoon, the European Central Bank responded immediately. In a single day, it injected 94.8 billion euros into the financial system, more than the U.S. Federal Reserve had supplied in the immediate aftermath of September 11, 2001, the largest single-day operation in ECB history. Interbank lending rates across Europe surged to dozens of times their normal level. Banks stopped trusting each other. The oxygen was being cut off. The ventilator switched on for the first time. Across the Atlantic, New York. Wall Street's 5th largest investment bank, Bear Stearns. As of late 2007, total assets, approximately $395 billion. Equity supporting that, $11.8 billion. Borrowed money was more than 30 times its own capital. The implication was simple. A 3% drop in asset value would wipe out every dollar of equity. This structure had one requirement. The market had to keep believing in their collateral. Bear Stearns borrowed short to buy long. Every night, they borrowed the next day's money. This is called a repo, a repurchase agreement. They pledged their securities as collateral and borrowed one day's funding. Think of it as using a rental deposit to borrow daily meal money. The moment that deposit is questioned, tomorrow's meal disappears. Through 2007, Bear Stearns' repo borrowings grew from $69 billion to $102 billion. Unsecured commercial paper shrank from $20.7 billion to $3.9 billion. The longer you hold your breath, the more air you need. This company was becoming more dependent on short-term funding with every passing month. June 2007. The signal came early. 2 Bear Stearns hedge funds collapsed. The high-grade structured credit strategies funds, invested in subprime mortgages. This was the first official receipt of the underlying collapse, but the market dismissed it. A hedge fund problem, not a firm-wide problem. That was the story. And 2007 ended with that story intact. Then came March 2008. Monday, March 10th, 2008. A rumor began to circulate. Bear Stearns had a liquidity problem. Moody's downgraded 15 mortgage securities tied to the firm. The stock closed at $62. Tuesday, March 11th. The decisive blow arrived. Goldman Sachs' derivatives desk briefly refused to process a Bear Stearns-related trade. When Heyman Capital requested to transfer a contract from Bear Stearns to Goldman Sachs, Goldman briefly declined. 16 minutes later, they reversed. But the market had already concluded. Even Goldman Sachs hesitates to be Bear Stearns' counterparty. That message spread like a signal. Wednesday, March 12th. Bear Stearns CEO Alan Schwartz appeared on CNBC. There is no liquidity crisis. The company is healthy. Off camera, something different was happening. That day, Bear Stearns received margin calls from 142 counterparties, totaling $1.1 billion in additional collateral. Cash was leaving. The oxygen tank had a hole in it. Thursday, March 13th. Cash reserves at the start of the week, $18 billion. Thursday evening, $2 billion. $16 billion gone in 4 days. 1/9 of what it had been 7 days earlier. Repo lenders began refusing the collateral. The mortgage securities Bear Stearns offered, no longer accepted. The oxygen was gone. Friday, March 14th. Before the open, the New York Federal Reserve moved. Through J.P. Morgan, it would supply Bear Stearns with $12.9 billion in emergency funding, the first time the Fed had directly intervened in an investment bank since the 1930s. Emergency lending authority, reserved for extreme circumstances, was invoked. The market did not read this as a rescue. It read it as a death notice. S&P downgraded the credit rating by 3 notches simultaneously. The stock fell 47% in a single day. Friday close, $30. Monday morning, March 17th, 383 Madison Avenue, Manhattan, New York. Bear Stearns headquarters. It was St. Patrick's Day. On Fifth Avenue, just a block away, the Irish parade was underway. Green hats, bagpipes, the cheers of revelers. A celebration and a funeral, side by side. With the parade sounds still audible, 14,000 employees walked out carrying boxes. White filing boxes, family photos, gym clothes, clear trophies commemorating past deals, address books that no longer meant anything. One entry-level employee left a record. It was my first job out of school. I thought it was a big company. I believed it would be a great experience. This is very hard to process. Bear Stearns employees held approximately 30% of the company's shares. For many, those shares were their retirement fund, a lifetime of savings. The asset that had traded at $170 per share was now worth $2. The boxes they carried out held what had once been the pride of Wall Street's elite. It took 72 hours for that pride to become a cardboard box. Across the street, others were walking in. They had crossed from 270 Park Avenue, J.P. Morgan headquarters. They were the due diligence team. They came to open the competitors' books. They came to identify what had value. This physical crossing was the clearest picture of the crisis's structure. We are not here to separate winners from losers. We are here to observe how those holding cash and credibility, the oxygen, came to hold the power to set prices. Now we look at the transaction record. What happened over the weekend? Sunday, March 16, 2008. Seller, Bear Stearns. Buyer, J.P. Morgan Chase. Asset, the entirety of the fifth largest investment bank in the United States. Peak price 1 year prior, $170 per share. Transaction price, $2 per share. Total transaction value, $236 million. Discount, 99%. $2 per share, 383 Madison Avenue, Bear Stearns headquarters. The building's value at the time, approximately $1 billion. Originally purchased in 2001 for $290 million. The entire company at $2 per share, $236 million. The building alone was worth more than the company. In effect, the company came free with the building. This was the price crisis made. But J.P. Morgan did not pay that $2 alone. The U.S. Federal Reserve established a special purpose vehicle, Maiden Lane LLC, named after the bridge connecting New Jersey to Manhattan. This entity purchased approximately $30 billion of Bear Stearns' distressed assets. The Fed provided $28.8 billion as a senior loan. J.P. Morgan contributed $1.15 billion as a subordinate. J.P. Morgan bore the risk of $1.1 billion in losses. The remaining $29 billion in risk was backstopped by the central bank. Taxpayer money supported a private acquisition. But the deal met fierce resistance at first. Bear Stearns shareholders said they would prefer bankruptcy to selling at $2 per share. The logic? Even the building alone was worth more than $2 per share. Joe Lewis, British billionaire. He held 9.4% of Bear Stearns. He had invested over $1 billion in the stock. The $2 price meant losses exceeding $1 billion for him personally. Shareholder opposition to the merger grew loud. 1 week later, March 24, 2008. J.P. Morgan revised the price from $2 per share to $10 per share. Simultaneously, J.P. Morgan purchased 95 million new Bear Stearns shares, securing a 39.5% stake. 39.5% of the voting rights, secured in advance. This preempted any chance for opposing shareholders to block the merger. The total deal was revalued at approximately $1.2 billion, 7% of Bear Stearns' market capitalization from 1 year prior. The final agreement, as filed with the SEC, contains all of this. Then, in September, the second transaction. September 15, 2008. Lehman Brothers filed for bankruptcy. Wall Street's fourth largest investment bank, gone overnight. This time, J.P. Morgan did not intervene. The Fed did not intervene. Panic spread. The next target was already identified: Washington Mutual, the largest savings bank in the United States. 10 days, starting September 15, 2008. $16.7 billion in deposits left Washington Mutual. Online banking, electronic transfers, a modern bank run, executed by mouse click. Then came the physical lines, outside branches in California, in Seattle, lines forming before dawn. Elderly depositors, small business owners, homemakers, passbooks gripped in both hands. They asked each other, "Is my money safe? Does the FDIC really guarantee up to $100,000? Police were deployed, not for robbery, to manage angry depositors. "This is everything I saved my whole life," an elderly man outside a California branch. Thursday night, September 25, 2008. The Office of Thrift Supervision shuttered Washington Mutual. The FDIC was appointed as receiver. Immediately, a purchase and assumption agreement was signed with J.P. Morgan Chase. This agreement remains in the FDIC's official records. Transaction record. September 25, 2008. Seller, U.S. Federal Deposit Insurance Corporation. Buyer, J.P. Morgan Chase. Assets acquired, $188 billion in Washington Mutual deposits. Branch count, 2,239 locations nationwide. Total assets assumed, $307 billion. Transaction price, $1.9 billion. Discount relative to assets, over 99%. A $100 asset priced at less than $1. The largest bank failure in U.S. history. Friday morning, customers who arrived at Washington Mutual branches saw a notice on the glass door. This bank is now owned by J.P. Morgan Chase. Ownership had changed overnight. The ATMs worked normally. Deposits were safe. But the brand, 119 years of it, was gone. This transaction cost the Deposit Insurance Fund $0. The same week, another transaction was underway on Wall Street. Sunday, September 14, 2008. Merrill Lynch, another Wall Street icon. In early 2007, its stock had traded above $90 per share. Friday close, September 12, 2008, $17. A call came in to Bank of America CEO Ken Lewis. On the other end, Merrill Lynch CEO John Thane. One day before Lehman's bankruptcy, preemptive sale negotiations began. Monday, September 15, 2008. Before the open, the merger was announced. $29 per share. Total, $50 billion. It looked like a 70% premium over market price, but it was 1/3 of the price from a year before. Now look at what 3 transactions produced. J.P. Morgan Chase. At the end of 2007, the bank held between 7 and 8% of the U.S. deposit market. Branch count, roughly 3,100. By 2009, total deposits surged to $938 billion. Branch count climbed to 5,100. Market share crossed 10%. U.S. banking law has a 10% rule. Any acquisition that would push a single bank's national deposit share above 10% is prohibited. In the emergency of 2008, the federal government granted an exemption. Under normal conditions, the deal was impossible. The crisis removed the barrier. In a single transaction, J.P. Morgan gained 2,300 branches across California, Florida, and Washington state, regions where it had been weak. A branch network covering 42% of the U.S. population was assembled overnight. At the same time, across the Atlantic, a different kind of transaction was underway. Northern Rock, a British mortgage bank. In September 2007, lines formed outside branches across the United Kingdom. The first physical bank run in 150 years. The British government could not find a private buyer. In February 2008, through emergency legislation, it chose nationalization. Shareholders' stakes were erased. The government took direct ownership. The British government spent 5 months searching for a private buyer. Virgin Group and others entered negotiations, but no deal could be reached. February 22, 2008. Through emergency legislation, the government chose nationalization. Shareholders' stakes were erased. The government took direct control. The US and Britain faced the same crisis and chose different solutions. The US, private capital backed by public guarantee. Britain, direct government ownership. The methods differed. The outcome did not. In both cases, taxpayer money went in. In the United States, the most direct bill sent to taxpayers was TARP, the Troubled Asset Relief Program. October 2008, Congress authorized up to $700 billion. U.S. population at the time? Approximately 305 million. The calculation circulated. Roughly $2,300 per person. That number repeated across congressional hearings and news broadcasts. Public fury erupted. But the final result was different. Actual disbursements: $443.5 billion. Banks repaid the rescue funds ahead of schedule. Dividends and equity sales generated returns. According to the U.S. Government Accountability Office's final tally in 2023, TARP's net cost to taxpayers? Approximately $31 billion. Per person? Roughly $100. 1/23 of what the public had feared. But there is something the numbers don't say. Before and after the crisis, the structure of American finance changed. In 2007, 5 major U.S. investment banks operated independently. By 2009, 2 had disappeared. 2 had been absorbed by commercial banks. 1 remained standing. Market concentration accelerated. The crisis liquidated the old order and installed a new one. And the winner had costs too. J.P. Morgan paid approximately $2.1 billion combined for Bear Stearns and Washington Mutual. Then came November 2013. The U.S. Department of Justice announced a settlement with J.P. Morgan Chase. $13 billion. The largest single corporate settlement in U.S. history at that time. The charge? Mortgage securities sold by Bear Stearns and Washington Mutual before the crisis. The $13 billion breakdown. Civil penalties to the Department of Justice, $2 billion. Payments to Fannie Mae and Freddie Mac for losses, $4 billion. Consumer relief for homeowners, $4 billion. Credit union loss compensation, $1.4 billion. State settlements, New York, California, and others, approximately $1.6 billion. All of it traced back to toxic mortgage securities sold by Bear Stearns and Washington Mutual before the crisis. J.P. Morgan argued the lawsuit was not its problem. Between 70% and 80% of the toxic securities were sold not by J.P. Morgan, but by Bear Stearns and Washington Mutual, the companies it had acquired. But acquiring a company means taking on more than assets. It means assuming the debts and the litigation risk that come with them. This was the price of playing rescue, a toll charged for expanding market dominance. Acquisition price, $2.1 billion. Settlement, $13 billion. Additional related legal costs. Total legal expenses paid by J.P. Morgan from 2008 to 2013, estimated at more than $28 billion, more than 13 times the acquisition price. The winner did not win unconditionally. The structure created the opportunity, and the opportunity came with a price tag. Now look at how Maiden Lane ended. The structure where the Fed injected $29 billion into Bear Stearns' toxic assets. Assets the market had declared untradeable. June 2012, the Fed's principal and interest were repaid in full. 2018, the final assets were sold. Final result? Net profit returned to taxpayers, $2.5 billion. The crisis collapsed asset prices. But the assets themselves did not disappear. The branches were still there. The deposit accounts still existed. The mortgage bonds recovered value over time. What moved was not the assets. What moved was ownership. This is not only the story of 2008. Every time a crisis comes, this structure activates. It is not asset value that disappears. It is oxygen, liquidity. When oxygen cuts out, even healthy assets become distressed sellers. The one holding the oxygen tank sets the price. When the crisis ends, that price becomes the new market order. Now, change the question. Not, will the next crisis come, but, in the next crisis, am I the seller or the buyer? Am I the one selling the fear or the one buying it? The assets we hold today, how quickly do they turn into cash when a crisis hits? The questions are simple. First, what share of our assets becomes cash within 72 hours? Second, how long can we hold without selling even as the crisis deepens? Third, do we understand that what we own is not just assets, but a ranking of liquidity? These three questions determine our position in the next crisis.